Microchip Technology's stock is down by 31.8% since May this year. Could this be a golden buying opportunity or a value trap? Let's go through our 7-step analysis process to find out how strong this company is, what can the future bring, and is it a buy at the current price? Microchip Technology's products are used in a wide variety of applications and end markets, including automotive, industrial, customer electronics, communications, aerospace, and defense. Let's start by examining the recent financial results of this impressive and diversified company to understand why its stock has taken such a significant hit. Revenue is down by 47% year over year. Net income is down by 84.4%. Cash is down by 10.5% in the last half a year, and debt is also down by 10.5%. So such short-term results can be pretty scary, and a lot of investors decided to sell. But such price swings can also create a great buying opportunity if the fundamentals of the company stay strong. We can basically get a great company at a discount because of short-term problems. So let's see, is it a golden opportunity, or is this company facing some real trouble over the long term? If you invested $1,000 into Microchip Technology stock 10 years ago, you bought 44 shares, and today they would be worth something close to $3,006. And this company also pays dividends, so in that time you would get $396 as dividends. So if we add together the current value of shares and the dividends, we get $3,402, and that is a gain of 240% in 10 years. So a very nice result despite the 31% drop in the recent months. And let's find out who benefited from such gains. Individual insiders, that is a check. 2.1% of the company is owned by individual insiders, and we like to see this number over 2%, so that is great. The management has a lot of skin in the game, and as a result, they are incentivized to take good care of the shareholders. And are individual insiders buying? That is an X. We see only sale transactions from insiders in the recent quarters. And do super investors own this company? That is a check. There are 2 super investors that own shares of Microchip Technology, including Wallace Waits, and this investment makes up 1.9% of his portfolio. And are super investors buying right now? That is an X. They didn't buy any shares last quarter and sold almost 5,000 shares. So let's try to understand why the management believes that owning a part of this company is a right thing to do. Return on invested capital, that is an X at 5.8%. 10-year median returns, and we want to see this number higher than 10%. So that is not a great start. And what do we know about net profit margin? It is a check, averaging 17.5% over 5 years, and the industry average is 16.4%, so they are just above the average. And now let's take a look at share buyback. It is an X. In the last 10 years, they issued 24.5% new shares. So they are diluting long-term investors. But to be fair, they are buying back some shares since 2022. And the debt? It is a check. It would take less than 2 years to pay the long-term debt with a 5-year average free cash flow. And that is exactly what we are looking for. The debt situation is looking good. So financial health of Microchip Technology is not exceptional, but maybe instead we should concentrate on its growth potential. Revenue growth, that is a check at 14.7% 10-year compound annual growth rate. And we would like to see this number higher than 10%. So, very nice. Free cash flow growth, that is a check at 16.6% in the last 10 years. Even better. And earnings per share growth, that is also a check at 14.4% in the last 10 years. We have checks all around. Microchip Technology is definitely showing some nice growth, and that can very positively impact our investment. But there is another way of making an investment work. The dividend yield is 2.5%, so shareholders can expect to get $1.68 annually per every share. And the payout ratio, that is a check at 48.3%. And we want to see the payout ratio below 50%, so that is great. Half of the earnings is going to shareholders and the other half allows the company to grow. And what about dividend growth? It is a check at 26.1% 5-year growth rate. And it was a stable growth that really accelerated in the last 3 years. So a growing dividend looks promising, but will it grow at the same rate? It is doubtful because of the payout ratio, which is in the sweet spot right now. But making an investment, even if it is just a dividend play, only makes sense if we are not overpaying for it. Price to earnings ratio is 47.3, so that is very high, way too high for my liking. But it sometimes may be misleading. The earnings went down by over 80% recently, but if it's only a short-term drop, then probably the PE ratio is not the best way to value this company. Instead, to calculate the intrinsic value of this company, we will use a discounted cash flow analysis. And we will use a 5-year average free cash flow for this calculation because we see some big swings in the last few years. So averaging things out should give us a more realistic picture of the company. Okay, so let's try to predict Microchip Technology's growth. In the low scenario, we will estimate a growth of 7% for the entire 10 years. In the medium, 10% and then 8%, and in the high scenario, 14% and then 11% growth. So the low scenario is showing a story in which Microchip Technology grows at half the speed it did in the recent decade. Medium is predicting that its growth will slow down, but not as much. And the high one is anticipating that it will continue to grow at a similar pace it did in the last 10 years, which is also in line with a predicted growth of the entire industry. So with such estimates, the intrinsic value in the low scenario is $70, in the medium $83, and in the high scenario $109. But we have to always apply a margin of safety to those prices. You can use any margin that fits your investment style, but I use a 30% one. And with such a margin, we get in the low scenario $49, in the medium $58, and in the high one $76. And the current price is around $68. It seems that Microchip Technology is fairly valued currently. But before we invest our money into this company, let's try to understand the big picture. Microchip Technology is a company with a very nice growth, decent dividend, and is fairly priced. But it is also diluting long-term investors by issuing shares, and its financial health is okay, but nothing really impressive. So let's put this company into perspective by comparing it to other companies in our Stock Ranking Pro. And for those of you that don't know, it is a ranking of all the companies we ever analyzed on this channel, and it allows us to easily find interesting investment opportunities. So let's group them by industry and let's find semiconductors. Okay, we have here 10 companies. And let's sort them from the cheapest to the most expensive one. As you can see, Microchip Technology is the third cheapest company from this group. But if we sort it by share buybacks, we see that it is diluting investors way more than any other semiconductor manufacturer in our ranking. Maybe not in the recent years because they started a buyback program, but in the long term, they are still diluting investors. And let's also get to our scores, and specifically the dividend score. So that is what I was expecting. It has the best dividend score of all the semiconductor companies. So it is a mixed situation. It definitely has its strong points, but there are also a number of things to consider before making an investment decision. Thanks for watching and see you in the next one.